So the balance sheet is quite possibly the most important of all the financial statements, but often the most overlooked. The balance sheet is your assets equals your total liabilities plus total equity. Think of it this way. You or your business has to pay for what it owns through either borrowing money, which is a liability, or bringing in external capital, which is equity. So your assets is your total debt plus your total equity. The balance sheet is very important and it can show you a few things. It is required for anyone tax-wise that has over $250,000 of revenue or $250,000 of assets. But what can it tell you from a financial perspective? Well, there's three categories we like to dig in with our clients: liquidity metrics, solvency metrics, and even profitability metrics. So let's give an example of what we would look at the balance sheet for. How about something called return on assets? Return on assets is your net income, your profit or your loss, hopefully your profit from your profit and loss statement, divided by the average total assets in a given period. What does this tell us as a business owner? This tells us how efficiently are we turning our assets into a profit. A higher ROA means that you are more efficient in generating profit from your assets, which is generally better, right? You have less capital inputs to generate the profit. Run this formula on your business, see what your return on assets is, and then compare that from month to month, quarter to quarter, year to year, and see if you can improve. But with that, we will continue next week with some more metrics, and hopefully the balance sheet starts to make better sense to people, as it's often the most confusing of the three financial statements.